Well, hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's show, I've asked Shaw and Partners, Adam Dawes, to look at some disappointing stocks that you might think about dumping ahead of June 30 to realise a tax loss, which can be used to offset capital gains you might have made on some decent and good shares. The companies I'm going to look at are Zip, Magellan, Tyro, EML, Mesoblast, Appen, Nuix, A2 Milk, and a couple of others. But before Adam, let me lay out some of the reasons why I'm happy to buy stocks on any future market dips or sell-offs, particularly between now and October. I do think the December quarter will be another good quarter for stocks, but there could be a few challenges in between. Now, most of you know my basic proposition for stocks going forward. It's a rising trend ahead, even if we do have sell-offs in coming months. The next Fed decision could be a confidence crusher for stocks in the short term, but I can't see a chance of it being a confidence killer. And neither can some of the pretty smart experts out there that I'm going to refer to. Before I get to these respected analysts, let's just recap on the big data drops and decisions that are on the horizon. Here they are. Locally, on Wednesday, we get the CPI for inflation for the May month. Now, this needs to be a good number to discourage the RBA against raising interest rates again in July. We get retail trade for May here in Australia on Thursday. But in the US, there's a whole lot of really important data starting on Tuesday with a huge run of economic data, including consumer confidence, home prices, and home sales. Then on Wednesday brings the Fed boss, Jerome Powell. He goes public in a panel discussion. If he says anything negative about interest rates, that will really spook the market. On Thursday, we see US economic growth, which is another important milestone or piece of data for the Federal Reserve to work out whether they want to keep on raising interest rates. But on Friday, there's this really interesting boring sound of statistic called the PCE core deflator, which is actually the Fed's favorite inflation guide. So whatever number that spits out on Friday, that could be a real help or hindrance for the stock market going forward. Then, of course, Tuesday week, we've got the RBA and its rate decision. And before that, we get house prices on the Monday. So a whole lot of really important pieces of data. Later that week, the US comes out with a jobs report, and that will be critically important before the US CPI on July 12th. As you can see, the next 2 to 3 weeks, really important data that could have a big bearing on where interest rates go and ultimately where stocks will go. Now, many of these readings could KO the latest US rally. That's my argument. But on the flip side, if the data drops are better than expected, and inflation falls, and the threat of recession is relatively manageable, then growth tech stocks will continue to go higher. Last week, I showed how the Magnificent Seven tech companies had driven the S&P 500 index up 11%. But if you took them out of the S&P 500, those Magnificent Seven companies are Apple, Microsoft, NVIDIA, Amazon, Meta, Tesla, and Alphabet, the S&P 500 was actually up 10%. If you actually just looked at them alone, they're about 60%. So they're an extraordinary tailwind for the S&P 500. But if interest rates are starting to top out or even starting to fall, a lot of those tech companies that have been ignored and growth companies will start to be bought by the stock market. And that's what I'm expecting to happen after October or so. Now, this is really interesting. And this comes from a market historian. He's a guy by the name of Sam Stovall, and he comes from CFRA in the US, which is an investment house. And this is really worth noting. This is a guy who I interviewed on Wall Street on my old Sky Business program a couple of years ago. And he's a very bright guy. And this is what he said. He said, with this year's S&P 500 gain of nearly 15% year to date through to June 16, history suggests investors hold on to their hats since a stellar second half may be in order. Now, Sam pointed out that when the S&P 500 index is up more than 10% through to June, and it's up about 14.5% year to date, The second half has averaged an increase of 8%. So we're looking at maybe 14.5 plus 8 be 22%. And that's nearly double, that 8% reading is nearly double the typical 4% average return for that same time period. And importantly, when the market is up over 10% in the first half and you get this big gain in the second half, it's happened 82% of the time. So that's a pretty high strike rate. Others agree with Sam, but I will have to ask you to become a subscriber to the Switzer Report to actually read what the other experts are saying. But let me emphasize there are some really smart people who do believe it's a good strategy to believe that stocks are going to go higher for the rest of this year, rolling into 2024. And if the markets do drop, it's a really good time to be a dip buyer. So let's now go to Adam Dawes of Shaw and Partners and look at a number of stocks, well, quite a number of stocks that have really performed badly. And you got to ask yourself the question, should I sell this before June 30? Let's see what Adam Dawes has to say. Welcome to the program, Adam.
Yeah, it's great to be here, Peter. Thanks so much.
Now, I've set the scene in my intro saying that we are going to look at a lot of stocks that have disappointed many investors. And with June 30 looming, people have to work out whether they want to realise those losses. Are you actually finding a lot of your clients are asking you the same sort of questions about whether they should realise their losses?
Well, absolutely. Or we, the advisor, is actually going to the client and saying, look, we've got these two positions that we're underwater on. What do you want to do? Do you want to take a loss this year? Those kinds of things. While we don't give tax advice, and I'm not a registered tax agent, we always will talk to the clients about if they want to or what strategies they can put in place as it comes up close to the end of the financial year.
Yeah. Now, what's the rule in relation to then if they want to buy this again? And I've always believed that, you know, if you're not doing it purely for the sake of taking a tax loss and then buying the same stock again, you know, straight after, well, you're entitled to have your view on, like, I don't like the stock now, but in a month's time, I might really love it again.
Yeah, I think a month is fine. Like, you know, especially, I think the tax department's certainly looking at if you sold 1,000 shares and then you went and bought 1,000 shares back 2 days later. Well, then there's really, there's something going on there. But yeah, if you were waiting for a month or if you're waiting for a little bit longer around that time, and then you could see the things were starting to change and get back into it, I don't think there's any problem with that. I mean, we certainly saw over the last week or so, our market move up in step for about 5 or 6 days. And then, you know, 2 or 3 days it took for it to, you know, to fall. So hopefully there is a little bit more buying coming into the end of the 30th of June, just to make everybody's numbers look a little bit better.
Okay, good. Let's go to the first one. This has been a great disappointment for lots of people, and that Zip, of course, was well over $12. Now it's, you know, way down lower than that. I must admit, I don't know what the current price is.
Yeah.
But the analysts think that there's a, like, the upside is probably 81% or something like that. But looking, if you took out the one big call merchant out there, it's probably more like 16% or 20% higher. What's your view on Zip over the next 12 months?
Look, with a 12-month view, certainly on something like Zip, I think you need to have a couple of things going in its favour. One, we need to see inflation starting to come down. 2, we need to see interest rates stopping from rising, in fact, starting to fall. And then consumer confidence and consumer discretionary spend starting to rise. Now, there's some really big hurdles there that we need to get through. So I'd be really cautious on Zip. Look, we at Shaw's have a very good outlook on it, and we're still very comfortable with the story, but it is going to take some time. So, you know, depending on your portfolio, maybe you do look at some of those bigger ones that have larger losses. Certainly Zip would fit into that category, and you've still got time, I think, next year being next financial year, to pick this thing up again and potentially at more of a discounted price.
Okay, let's go to one which another been a big disappointer, and that is Magellan, the stock. Yeah. What do you reckon is going to happen there?
Well, yeah, again, there's a couple of catalysts that need to happen. One, you need to see inflows into the story. So that's certainly one thing that needs to happen. 2, you need to see the performance starting to tick up. Now, we looked at the performance the other day. It is actually started to move in the right direction with the US market, as well as some of those tech stocks. That's actually moving, but the outflows still continue to happen, and that's where we've got some issues. So I really think Magellan, look, certainly it's not bad around here. I wouldn't be selling it this financial year. I'd be looking at this one. I'm somewhat of a believer, and I think this one should turn around. But certainly outflows have got to slow down, and performance, and both of those are still a little bit anemic at the moment.
Okay, now I've got to ask about Tyro because I've lost money on Tyro. A lot of people have. All the analysts like it. I think the consensus is about 158, no, 96% higher. The most optimistic is odds. They think 158%. What's the Shaw and Partners view on Tyro?
Look, I think Tyro, that's a really tough one. I think with no remaining suitors is going to be an issue. And then Tyro definitely looks fundamentally expensive against some of these macro headwinds. Now, we've got to remember that they rely a lot on discretionary spending. So that's a big key thing for them. But 88% of their spend is non-health related. So that is very much discretionary. And look, with Potentia Capital withdrawing their interest in there, I don't see many catalysts going forward for the story. So I'm sorry to say this one, Peter, I'd be probably selling this one and moving on for somewhere else.
Okay, let's go to EML, another disappointing company. It's often looked fantastic. The market's bought it and some of the problem came along. EML, would you be a seller before June and maybe waiting to see whether some signs start to improve?
Yeah, I think you could. You know, certainly with Miss Shand resigned the other day, and that's due to an operational change that she was going to put in. She put in, there was about 9 months where she looked at doing this long turning around of the business and things like that. I never really like getting involved with stories or stocks that have fractions in the management team, but also then ones that have any lawsuits or any sort of pending issues. EML definitely has a lot of pending issues in Ireland, anti-monetary laundering, those kinds of things. Look, it's been a shocker going forward. I'd be comfortable to get out of that one as well. I think you could find some better places to put your money.
Yep. On the subject of a disappointing stock, what about Mesoblast?
This is one where I throw my hands up in the air and I say I have no idea what the hell this stock is going to do. Yeah. Look, on a charting perspective, if you actually look at a chart, it's actually looking like it's bottoming and it's getting higher highs. So that I think is something that is really important. So potentially the trend is there, but I don't understand the story. I don't understand the science. I know it's got this great breakthrough. For me, biotechs, I steer clear of them. So I'm just going to say I don't know on this one. I think there's better advice.
Another easy one, Appen. HGX.
No one likes it. That's what I heard. No one likes it. So, look, again, departing of the CFO that just came out or a while back, I mean, it points that they most recently are still having some problems internally as well. Nonetheless, I don't think the view that the market has turned around on this one. I think this one probably would have been some of the biggest losses. Or we've got one more stock coming up that maybe that happened. But yeah, look, for me, I don't feel that that's a place for you to be. It's a tough space, and we're seeing all of the big tech guys doing it themselves. And so they've really had to try and change their business model, which is going to take a long time to improve. I think you've better money elsewhere on that one.
All right. What about Nuix? It looked like the genius company until it didn't.
Until it didn't, exactly. And look, this is another one where you've got the problems with internal fighting. You've got the managing director and ASIC investigating the buying and selling of shares around in and outside of their reported period times. You've also then got issues with the business having to turn itself around as well. This probably might be the one that everyone's got the largest losses on. For me, again, I hope we're going to end on a good one here, Peter. But yeah, for me, again, I think this one, again, you just don't need to be there. Yeah, you can take some losses. And look, you can come back in on July the 10th, July the 15th, and it'll probably be the same price anyway. So I think this one is one to put in the sin bin for me.
A2 Milk. I've come up with some real doozies, haven't I?
You have, haven't you? Look, this is probably the most positive one, I think. in this, and really it's a joint announcement that Synlait Milk came out with their SAMR. SAMR is basically the ability for Synlait to produce or put A2 milk in infant formula to be sold in China. Now that's massive. That is huge, and I really thought the share price would have really rallied on the back of that. But I don't think the market's seen. Well, they've probably seen it, but I don't think they've attributed so much to it yet, because it is looking to come back through in the second or last half of this year. So I think you'd be holding A2 milk. I'll be a happy buyer of this story. It's already had weakness. I'm comfortable with A2 milk. I would say do not sell it.
Okay, this is a pretty small one, not covered by analysts, and that's Magnus Energy Technologies. It kind of looked good when it came on the scene. Do you have a view on it?
I do. I mean, I got a fair few clients in it myself. So what's happened over the last couple of months is that the market's been waiting on this accreditation for it. Accreditation is basically 8 steps to working to be able to take the battery that they're producing to be able to travel that around America or transport it, plus also then internationally. All of those numbers have been ticked off except for number 7, and the market is still waiting for that number 7 to come through. It should come through in the next coming couple of weeks. But really then I just think the market's lost confidence in this stock and in this story, even when the certification's coming through. We know that they just raised 25 million through L1 Capital and Regal. So they've got some cash in the bank. Their CEO just resigned, but we knew that was going to be to happen because there's talk of a reverse SPAC in the US, which Magnus is going to go through and work on. So there's lots of stuff coming up with Magnus, and we're waiting on this last certification. I'd be cautious not to sell this in, because I think that the news is looking pretty good over the next 6 months. But again, it's up to the individual.
Okay, we'll call that one a keeper. And finally, Dicadata. And I've interviewed the CEO and founder. He's a character. But this company has really kicked the lights out of its international rivals. And I've recently talked to one of his international rivals who really respects this guy.
So problems with the stock, it is low liquidity. The family does own a lot of that stock, so it is quite difficult to get yourself set. And so if there is a seller there, it does move the share around. The stock has underperformed definitely over the last sort of 6 months or so. It has definitely fallen from its peak. But they resell computer hardware to around about 8,600 suppliers or resellers. So, they're in the really perfect position, and obviously getting, Cisco and all of these big providers to go with it. I've always liked this story. I think you've got to look at the chart and potentially look for a bottom, and I don't know where that is at the moment. But that one, I'd be a little bit cautious on selling here. I think that these guys can turn around, and certainly computer hardware is always needed. Post-COVID, it's gone well, but I think there's just been some selling going forward. So I'd just be cautious on that one as well.
Yeah. I know I've looked at the Dicadata chart over the maximum time frame, and it looks like Microsoft. Went nowhere, and all of a sudden just went through the roof. And it's a very interesting company, but question marks over it. But I do think it's a reasonable business, and I guess it fits the mold, doesn't it? Small tech type company, even though it's not technical software, but it's in the tech space. It's a small company, and small companies have not had it easy with high interest rates. I mean, I think when interest rates come down, a company like that and other small cap companies will be surprise positive performers.
Yeah, agree. As well as the confidence coming back into the small cap space, we've really started to see that the small caps haven't moved. It's all been about the large caps and the mid caps. So once that confidence comes back into the market, absolutely those guys will naturally get lifted as well. Okay.
One last one before I go. What's your stock of the week? What are you telling all your clients? You can't miss this one. This is the Adam Dawes Destroyer.
All right, so I own stock in this one, so I'm going to put my hand up and say, and there's my disclaimer that I own shares in this business.
Right.
I really like a small company called IPD Group, which the stock code is IPG, just to make it all a little bit more exciting. But IPG is a business where it's an electronics business, but they basically make charging stations for electronic vehicles. Now, there's around about 5,000 charging stations around Australia. By 2027, we need to make another 1,000 stations or charging stations coming up. This one has got, they just upgraded last week in their numbers for EBITDA higher growth. And I think this one's got a good runway over the next coming couple of years. IPD, stock code is IPG. That's my number one pick at the moment.
Yeah, a lot of people think of IPD education or IDP.
That's right. That's right.
Yeah.
Don't do that. IPG, GG. So yeah, all good.
Adam Dawes, thanks for joining us. See you in a couple of weeks' time.
Thanks, Peter. Great to be here.
And that's the show for tonight. Thanks for joining us. You got to remember there are really important investments out there, but the timing of your investments can be really important. That's something worth thinking about when it comes to June 30 and those stocks that have underperformed and let you down over the course of the year. If you want to know more information or get some more insights on what you can invest in, as I made the point earlier, become a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. I'll see you next week.